Good afternoon, everyone, and a very warm welcome to all of you joining us today. It is a real pleasure to open the fifth ACTP webinar series, which this time is dedicated to the transactional comparability approach, a topic that continues to spark important discussions and raise complex questions in the field of transfer pricing. This series is part of the research webinar program organized by the Amsterdam Center for Transfer Pricing and Income Allocation at the University of Amsterdam. And this series brings together academics, practitioners, and policymakers to exchange perspectives on key developments and, most importantly, the most complex issues in international taxation and transfer pricing. So throughout this series, we will explore some of the key areas of dispute and controversy relating to comparability. We will also take a closer look at how the transactional comparability approach can be applied to transactions that are not undertaken by third parties, and we will consider the impact of the new risk framework on the application of comparability in practice. So today marks the launch of the series, and we are very pleased to begin with the first session, Transactional Comparability, Disputes and Controversy. So this session will be moderated by Federico Lo Bianco, and we are delighted to welcome two distinguished speakers, Rezan Okten and Scott Wilkie, who will guide us through the technical and practical dimensions of today's topic. So in this opening session, we'll cover several important issues that Federico will share with you in a minute. And looking ahead, we also invite to join us for the next session in this series, which will continue to explore the practical application and future of the transaction comparability approach. So the second webinar will take place on Wednesday, the 9th of April, and we'll address the topic of the application of the transactional comparability approach to multinational enterprise transactions not undertaken by third parties. The session will be moderated by Richard Collier with expert contributions from Lachlan Molesworth and Dominic Vines. And the third webinar will take place on Wednesday, the 21st of May, and is titled, Has the New Risk Framework Approach Killed Off the Transactional Comparability Approach? This session will be moderated by myself with speakers Jan Dykes and Diana Hay sharing their insights. So all the information about the upcoming session along with the registration links is already available on our LinkedIn page. And once again, thank you for joining us today. And myself, and all of us are looking forward to an insightful discussion and engaging discussion also with Rezan, Federico, and Scott today. And with that, let us begin. And Federico, the floor is yours.
Good afternoon, and thank you, Svetlana, for your introduction. My name is Federico Lo Bianco. I am a Doctor Europaeus at the Core University of Vienna and also a research fellow at the Amsterdam Center for Transfer Pricing and Income Allocation of the University of Amsterdam. Today, I have the pleasure to introduce you to two distinguished speakers, Rezan Okten and Scott Wilkie. Rezan is an experienced transfer pricing practitioner, currently partner at Dentons in Amsterdam, and is also one of the founders of our research center. In his long experience, Rezan has advised various multinational firms active in multiple industries. His dedication to academia is also evidenced by his long-term dedication to the activities of the University of Amsterdam, with which he has been collaborating for more than 10 years now. Scott is a senior counsel at Blakes, Castles and Graydon in Toronto, and he has been working in the area of international taxation for more than 30 years, with a focus on income taxation, corporate tax, transfer pricing, and tax treaties. But he is also a research fellow at our center and is consistently contributing to our activities. Moving to today's webinar, this is the first of our series consisting of 2 webinars, as Svetlana mentioned. And today we will discuss the concept of comparability, the 5 comparability factors in order to understand their actual meaning and possible application, together with the issues and controversy that the approach raised in practice. So first, Scott will introduce the concept of comparability and the 5 factors, and then Rezan will follow up with the controversy and case law. So Scott, the floor is yours.
Thanks very much, both of you, Svetlana and Federico. Um, Comparability and its reference to transactions in the title to this webinar are not accidental, and they're not the same thing. And as we'll explore for a few minutes, their complementarity is presents difficult considerations both in practice and when taxpayers uh, come into controversy with tax authorities. Comparability, of course, is what drives the so-called arm's length standard or arm's length principle, which lies at the heart of the transfer pricing guidelines. But as I've tried to show by putting comparability in quotation marks in the title to this slide, the foundational questions are comparability to what, comparability to whom, and comparability according to what standards. The a foundational question that the transfer pricing guidelines implicitly present but don't answer is whether comparability presents a prescriptive standard, that is, a set of rules with guidance emanating from those rules, or is merely a descriptive point of reference, that is, almost stating the obvious that uh, uh, in evaluating the circumstances of a taxpayer, one has to look at the circumstances of a taxpayer. So where do we find guidance? Where do we find guidance in what comparability might mean, generally or in any particular circumstances? And more to the point, where do we find insight into what may be guiding the mindset of tax authorities as they examine taxpayer circumstances, and from a taxpayer's point of view, strategically, how a taxpayer should position itself to anticipate, and I think anticipate is the right word, anticipate controversies and disputes with tax authorities. Not mean-spirited disputes necessarily, but simply significant disagreements that arise naturally from countries being in conflict with each other through the activities of their taxpayers. The controlling guidance, which many forget, I think, is found in Article 9 of the OECD Model Tax Convention, which encapsulates the arm's length principle. I have it here on the slide. I've highlighted a number of key notions that are embedded in it that we'll explore in some of the following slides. But what I really want to draw our attention to as a platform for the next parts of our discussion are the references in Article 9 to profits, profit allocation, profit splitting, with reference to the circumstances of independent parties. But what's not in Article 9? And think about what's not in Article 9 in relation to the voluminous transfer pricing guidelines. Does Article 9 say anything about transactions? No. Does it say it speaks about conditions made or imposed. It speaks about commercial and financial relations. It doesn't say anything about transactions. It doesn't say anything about revenue or expenses, nor does it reflect the sort of the modern creations emanating from BEPS of value creation, accurate delineation, commercial rationality, recharacterization or non-recognition. And notably, it doesn't say anything about price. So how do we get into this morass of comparability analysis, trying to detect the transfer price from what is the foundation of the arm's length standard this way? Uh, I think this drives us then to examine a little bit more carefully what factors, what considerations might go into a comparability analysis, at least as the OECD purports to guide us to do that now, Federico. The comparability factors, or the tenets of a comparability analysis, as most recently set out in the transfer pricing guidelines, have two components. Yes, there are 5 comparability factors, and they're itemized on this slide. But I think it's helpful, particularly thinking about what Article 9 of the OECD Model Tax Convention commands us to think about, to break these down in their modern incarnation into two components. The first is the overarching commitment in the transfer pricing guidelines to economically relevant characteristics, so-called accurate delineation of transactions with a focus on, quotes, value creation and trying to detect commercial rationality in the conduct of a taxpayer. I'd like to stop there for a second and ask all of us, well, what do any of those terms mean? Back thinking about what we've started with, are these prescriptive terms? Do they speak in terms of what they mean? Are they descriptive terms? Are they providing some guidance or some insight into the mindset that should be brought to bear in a transfer pricing analysis? What exactly are they communicating about a taxpayer's circumstances? But more to the point, what are they communicating about the latitude that tax authorities have in contesting the validity of taxpayers' commercial arrangements and their pricing and income allocation outcomes that come from those arrangements? The OECD guides us, and just to say this, recently, for example, the Canadian tax authorities have tried to outline what these notions, economically relevant, accurate delineation, value creation, and commercial rationality might mean. And the best that they've been able to come up with, which is not a criticism of those tax authorities, this is almost obvious flowing from these notions, is a focus on economics, a focus on what, quotes, actually occurred, imposition of, quotes, economic tests. As we'll see in a few minutes, that begs a number of important questions that in any transfer pricing analysis, in any controversy, are going to have to be addressed. Now let's think a little bit about what the OECD says are the rules, the prescriptive standards that are brought to bear in fleshing out this notion of comparability. The OECD is telling us that in any transfer pricing analysis, we should be paying attention to contracts, we should look at the contract terms, we should engage in a circumstantial analysis of functions and assets and risks. We should examine the property and services that are conveyed in a transaction. We should look at the context, the economic context in which the taxpayer is engaged in its activities, and of the markets in which the taxpayer is presenting itself. And we need to look at business strategies. What do we get from any of those? Do we get something that's precise or specific or controlling or even mechanical? And I think at this stage, it's also worth bearing in mind that as methodologically dense as the transfer pricing guidelines are, now built around these so-called comparability factors. In fact, the notions that are reflected in this slide in updated linguistics are really no different than those that framed the original 1979 OECD transfer pricing guidelines. And it's also useful, again, from a strategic and a tactical point of view in thinking about disputes and controversies, to remember that what we now mythologize as the OECD's transfer pricing guidelines are essentially a lift, a pickup of notions that were developed by the United States in the 1960s in response to United States tax and fiscal policy concerns about U.S. multinationals effectively exporting their activities and the income arising from them. They reflected a defensive measure from the United States point of view. And as we seek to understand what these mean in a modern context, we should think about their origins. Now, in testing I don't know, Federico, whether that you have anything that you'd like to contribute to the evaluation of the comparability factors, but in moving forward, I think the useful question to ask, as the next slide attempts to do, is what does comparability actually mean? Are these normative factors? Are these standards? Do these reflect principles? What does comparable mean? It's certainly not a dictionary notion. It can't mean the same or similar or equivalent, or can it? How do we know what comparable means? As we've talked about in the last few minutes, are we really entirely focused on economics versus law? You might imagine asking yourselves, what's the most difficult comparability factor to deal with? What's the most difficult aspect of a comparability analysis that we have to contend with? We might look at the 5 factors and say, well, maybe it's not so hard to find the contract terms, but maybe evaluating functions, assets, and risks is a difficult thing to do. For example, the OECD's transfer pricing guidelines anticipate, as a very important article by Richard Collier and Ian Dykes of a number of years ago points out, almost a day-by-day, meeting-by-meeting evaluation of decision-making in order to try to estimate where risks are born, which of course is a cumbersome way of analyzing transactions. I think that there are 2 aspects of the comparability analysis relevant to disputes and controversies that are particularly vexing, particularly difficult to deal with. The modern incarnation of comparability analysis focuses very much on economics. The notions of accurate delineation, of economically relevant characteristics, of value creation, of commercial rationality. These are not prescriptive standards. These are not rules. They don't come from the law. They are descriptive ways of wondering about whether or not taxpayers are using their common control in order to shift profits in ways that are not commercial. Certainly that's the case. But one might usefully ask the question, whatever happened to the law? That is, this is the transactional element. Transactions arise from taxpayers' application of the law, of the private law. The private law gives life, legal life, to legal personalities, the corporations that participate in these transactions, and establish the characteristics of transactions that the taxpayers rely upon. When we think about, and this is why I think accurate delineation is the most troublesome aspect of the comparability analysis. Not the 5 factors, but the objective of applying them. Isn't the transaction that the transfer pricing guidelines seek to evaluate the arrangements as the taxpayers have arranged them? Isn't the question underlying a transfer pricing analysis whether, taking it into account relevant evidence, the parties to a transaction have the financial and functional capacity to participate in the transactions as they purport to do, and to enjoy the rights that arise from those transactions in a meaningful way? The question isn't, could the taxpayers have done these transactions in a different way from a legal point of view? Probably, in many instances, they can. The law gives definition in particular ways to economically equivalent outcomes that could just as easily have different legal packages. So a very hard question, as even some countries are seeking to do, is whether or not tax authorities are justified in not recognizing, in recharacterizing transactions in an image that is not the image in which taxpayers have composed them, simply because the economics of the arrangements are capable of being expressed in a different way. And if and to the extent that tax authorities adopt that outlook, and as I mentioned a few minutes ago, the Canadian tax authorities, for example, have tried to give definition to these sorts of notions by focusing on economically alternative ways of reaching the same transactional destination, then you almost have a situation where tectonic plates are slipping over each other in a dispute. Taxpayers look at things this way, the tax authorities insist on looking at things that way, and we're no longer analyzing transactions, we're expressing different points of view on possible economic outcomes. The second point, which is highlighted in the red at the bottom of this slide and goes back to how I started my part of this presentation, is comparable to what and why. Many of us on this webinar will recognize that a less talked about notion in transfer pricing, but one nevertheless that's relevant to transactional comparability, is sometimes described as the halo effect. That is, who are the comparable taxpayers? Are we talking about external comparables? That is, truly independent parties who, in their own interests, are engaged in transactions that have some kind of similarity or equivalence to those that we're trying to examine with respect to our taxpayer? Are we being more insightful in that analysis? As again, referring to the Canadian courts, a case that you probably know, the GE Capital case, are we thinking, well, no. I mean, when we're thinking about comparability, we cannot discard the characteristics of the corporate group of which the taxpayer is a member. And therefore, just as is often the case in transfer pricing, it's very difficult to find comparability because taxpayers are different. They're in legal terms, corporate, in commercial terms, they're genetically different from each other. They come from different experiences. They originate differently. And even if transactions look as a picture, as if they're similar or equivalent or even the same, the essential characteristics of the taxpayers who are parties to those transactions are different. They're different. And therefore, a critical question, which gets more and more difficult to answer to the extent that tax authorities are reserving to themselves an entitlement not to recognize transactions as they have been formulated by taxpayers in reliance on typical legal constructions. How do we actually establish what relevant comparability is? Surely it's not simply that economically equivalent outcomes are to be judged as being economically equivalent because they're economically equivalent. There has to be something more to it than that. And that leads us then to start thinking even harder about the analytical focus that we should be bringing to bear on this analysis, which we can examine more closely with the help of the next slide.
Scott, before moving to the next slide, as a takeaway of this slide, are you wishing for the creation of dedicated definition of comparability, comparable, transaction, delineation? Do you think this can help in achieving tax certainty?
No, I don't. I think that the starting point for our transfer pricing analysis, and indeed, if one looks at how transfer pricing analysis originated, and not in any of our memory, well, maybe me, I mean, I'm older than you, but how transfer pricing really originated. Transfer pricing analysis, it didn't originate to reconsider whether taxpayers could have done things differently. Transfer pricing analysis, as we'll explore again in the next slide, is focused on profit misallocation based upon the use of corporate control, corporate power to do things that are unnatural in the circumstances. And from that recognition comes all of the difficulties associated with comparable. It is, the transfer pricing guidelines, to my mind, present a variety of analytical devices which may be helpful in detecting whether or not there has been what I would refer to as a chauvinistic exercise of control, meaning that the exercise of control to do things that are not commercial in the circumstances. But the starting point for the transfer pricing analysis, any transfer pricing analysis, isn't what the taxpayer could have done differently. It's what did the taxpayer do? So when I look at a transaction of purchase and sale, or I look at a transaction of corporate capitalization, or I look at a licensing transaction, or whatever the transaction happens to be, the question that I should be asking myself is, well, could the taxpayer have done this differently? Instead of borrowing money, could it have capitalized its subsidiaries using equity by issuing shares? That's not the question. The question is, well, given what the taxpayer did, does a close examination of the evidence tell you that having chosen a particular pathway, the taxpayer behaved accordingly, and that it had the capacity to do that? That is, transfer pricing analysis also presumes analyzing participants, economic actors in transactions on an independent or standalone basis. So as independent actors, could, even though as members of corporate groups, could these parties to these transactions, either directly or using appropriate and typical outsourcing arrangements, have conducted these transactions? And if the answer to that question is yes, then what is the basis for saying, well, alternatively, because it yields a different tax outcome, they could have done this in an economically different way? Or the business strategy that's been adopted by this taxpayer isn't commercially rational. How do you know that? Indeed, I would suggest that, and I think that comes from Article 9 of the OECD Model Convention, which is what encapsulates the arm's length principle. We're reconsidering the allocation of profits. We're not mandating a forensic transactional reconstruction. I think that an examination of losses, which the transfer pricing guidelines have never done very carefully, gives real insight, particularly from a dispute and controversy point of view, into what's going on in the transfer pricing analysis. It's very easy to engage in a profit reallocation if there are profits. There's something for everybody, and then we're simply fighting about or debating what the relevant share might be. What happens if there are losses? The transfer pricing guidelines say, well, do everything the same way to reallocate losses, but think about what it means to reallocate losses. What happens when a jurisdiction essentially is reallocated to it more losses? Those losses are tax shelter against income that would otherwise be taxable in that jurisdiction. How happy are the Italian tax authorities to receive an allocation of losses from Canada that results in a reduction in the Italian tax base? That is implicit in any transfer pricing examination is a conflict between the taxing authorities about their relative responsibilities in relation to each other. Now that sounds very macroeconomic and theoretical, but it's not, because it's what animates the transfer pricing discussion. It's what animates tax authorities' feeling of entitlement to disregard transactions in favor of economic alternatives. And indeed, it's what underlies Pillar 2. We wouldn't normally think of Pillar 2 as a transfer pricing initiative, but what does Pillar 2, for example, really do? It takes an eraser to all of the private law constructions that define transactions and establish legal personality and says, look at the group income and divide it up in what Pillar 2 conceives to be an economically rational fashion. So where does that take us in terms of transfer pricing analysis? Where does that take us in rethinking the notion of comparability from questioning the notion of comparability from both a strategic and a tactical point of view in giving advice to tax authorities, and indeed as tax authorities thinking about tax authorities' relative positions country to country in relation to each other? Maybe it takes us to wonder whether or not these comparability factors that we've been talking about present something of a mirage. Something of a mirage. And I think, as I come to the end of my comments and try to provide a segue for Rezan, I think there are three key things that I'd like us to be thinking about when we examine some actual transactional circumstances. The transfer pricing guidelines have always created an impression, an appearance of objective scientific analysis. But back to your question, when you think about it, when you think about all these new notions or new linguistics for notions that have been built into the transfer pricing guidelines, how could they ever be normative standards? They're not normative standards, and more to the point, they're not entirely faithful to what Article 9 expresses to be the arm's length standard. The inevitable result of having these loose notions that invite economic comparisons and provide a validation in some cases for disregarding legal considerations is that transfer pricing arguments are infinitely malleable, depending upon what the point of view is, whether the taxpayer in relation to the authorities or whether the authorities in relation to each other. And that causes us, I think, to think very, very hard about what's really going on. As I said a minute ago with reference to Pillar 2, what tax authorities really want to do in a transfer pricing analysis is ignore the fragmentation of unitary economic enterprises that are multinational enterprises that effectively define themselves using the legal constructions. They want to avoid the fragmentation that arises from how transactions are created and by whom they're created, and look at the economic whole. And that's an objective that's not entirely unfaithful to what Article 9 speaks to, which is an allocation of profits and a detection of whether or not reliance on legal constructions for their own sake misrepresents how income is earned. And now it's interesting, and I'll conclude with this. I'm sure all of us, and again, this is not a criticism of tax authorities, but we can move on to the last slide for my part. There's some recent insight in all of the things that I've been speaking about for the last 20 minutes or so. One can be forgiven for wondering, whether or not, despite the appearance of mechanical facility in the transfer pricing guidelines, all dedicated to applying the notion of comparability, there are no prescriptive standards. Underlying every tax controversy, every dispute, whether it's a dispute between countries about what the proper allocation of a multinational's income is, or whether it's a dispute between the multinational itself and the tax authorities about where it earned its income, is a statement of position by each of the parties, or one would hope to be a statement of position by the parties. The Canadian Tax Court very, very recently was confronted with a typical tax authorities approach in the next stage of a celebrated transfer pricing case called Chemical Corporation, which you may be familiar with. Many of you may be familiar with. And the tax court delivered what I think in the transfer pricing environment is a unique order. It said tax authorities, and I've quoted from the order. So look in particular, if you would, at items A and B in the order. The tax authorities, the tax court said to the tax authorities, you have to tell the taxpayer what you think the right arm's length price is. You have to tell the taxpayer what you're relying upon specifically, precisely, analytically, as the better price. It's not enough to say, well, the taxpayer could have done this, or the taxpayer could have done that, or poking holes in the taxpayer's argument. You have to say what your position is. And secondly, as item B says, in examining the terms and conditions of the relevant agreements, think back to the allocation factors that we spoke about a couple of slides ago. It's not enough to say we have a different view, or maybe the allocation factors could have been applied this way, or maybe the risk analysis could have been different. You have to look at the terms and conditions of the taxpayer's transaction as the taxpayer undertook it, and tell the taxpayer why those are not good terms and conditions, why those are terms and conditions that a so-called independent or arm's length party would not have agreed to do. And I think that encapsulates everything that I've been trying to say for the last 20 minutes or so with respect to the notion of comparability and how slippery, how difficult it is to hold on to, notwithstanding the appearance of methodological precision that the transfer pricing guidelines try to present. And with that, I think we're going to now think about a little bit about some particular adjudicated transfer pricing controversies and how these issues arise.
Thank you, Scott. Yeah, thank you, Scott, for introducing us to the key and core points of the current compatibility framework. Now, I would like to give the floor to Rezan, who will present 2 examples and 4 case law where the concept of comparability and the use of the comparability factors played a crucial role. Rezan, the floor is yours.
Thank you, Federico, and Scott as well. I'm not sure if I'm going to be able to cover all those cases. I don't think we have enough time, but let's see how much we can cover. If you have been listening to Scott and feeling like that this field is very complex, you're not alone. I've been practicing this 18 years and still feel like I'm at the beginning after listening to Scott, his very impressive speech. But there is also hope because even though the principles we have are not perfect, they still are the best out there. I think it's good to shift the gears now to kind of to see how these nice or structured concepts behave in the wilderness, as Scott put it out there. But for me, it was also very important to remind ourselves, actually, to what Scott has repeated throughout his slide, what transpricing is really about. It's about allocation of profits, consolidated profits of a group among its members, and it could also be losses. And we, at this point in time, we use pricing of transactions as one of the methods using comparability analysis. We could have relied on global formulary apportionment, which has its own challenges, perhaps not this challenge, but it's very good to keep that objective in mind. If we lose sight of that objective, either as taxpayers or tax authorities, then we, as Scott put it out, we create our kind of the benchmarking mirages that would result in distorted outcomes. And I will be presenting two transpricing audits, which are about actually method selection, not so much about benchmarking analysis. And one of the court cases is also about that. And that also is a clear indication that comparability is actually first about delineation of the intercompany transaction and then pricing of the transaction, which then first start with method selection and benchmarking study. So it starts with method selection. If you select the wrong method, then you may not also arrive at the right price. Now, starting with the first case, here we have a contract manufacturing company in an Eastern European country selling products to, let's say, a principal reseller in a Western European country based on a contract manufacturing agreement. And that principal reseller sells around the world, basically, but mainly in African markets. Then that same contract manufacturer happens to sell the same products to a couple of European countries in what we call high margin countries compared to African markets. Now, then, if you look at it kind of on paper, even though I gave you a couple of hints, this looks like a textbook internal CUP, right? Almost like a perfect CUP. Same product, same manufacturer. Why can you not use it? Well, that's what the tax authorities told so as well. But it's not as simple as that. In order to find out whether these are truly comparables, even though they are imperfect, if you run through the comparability analysis, you will come to the conclusion that they are, in fact, far from being comparable. Let's start with product characteristics, which is, in fact, if you look at it, it looks like it's the same product. But the contract manufacturer was producing 60 to 80% of its products to the principal, whereas the remaining portion was only sold to the third parties, which is, well, if you look at the volumes are significantly different. And the question is whether it is still comparable. Then if you look at the contractual terms, which is, again, on paper, you can arrange it, but you need to test it with functional analysis as well. There was a contract manufacturing agreement. Can you actually, going back to private law, can you just ignore that? Can you just disregard it without any support? Whereas with the third party, there was a basic buy and sell agreement. Now, if we look at the functions and risks, in this case, the principal reseller was also holding ownership of intangibles, valuable intangibles like trademarks, trade names, know-how in relation to healthcare industry, recipes, patents. All of those were ignored by in this case, the tax authorities arguing that it's not a contract manufacturer. It's actually just a fully fledged manufacturer, and instead of TNMM determining and kind of a routine remuneration for a contract manufacturer, you should use the CUP method, that has been applied in the sales to third party in Western Europe, which were significantly higher prices that were used for the related party transaction. Then if we look at the economic circumstances, well, one is mainly selling to African markets, the other one is selling high margin European markets. Again, another difference. And finally, in terms of business strategy, the principal reseller has set up this company with long-term vision in mind and invested a significant amount of capital building this contract manufacturing activity, which was also overlooked in this case. Then what is really bizarre in this case, not only that the tax authorities rejected the TNMM and used the CUP method, they also completely forgot about the consolidated profitability view. The adjustment they made went way beyond the consolidated profits that were made in the entire group. So they made the adjustment twice as much as the consolidated profits that were made, leaving the principal in a significant and unsustainable loss that would never be seen if you would be dealing with third parties. Nobody would do business in that way. That's also showing that tax authorities, if you don't use even these imperfect tools that we have, comparability factors, you may be getting to extremely wrong outcomes. Let me pause here if there are any questions from you, Federico or Scott. Otherwise, we can move on to the next slide.
We can move on.
Well, the second case is also about whether a company is a manufacturer or a contract manufacturer in this case. But in this case, the manufacturer is in a Western European high-cost environment, and principal is in Eastern Europe. And what basically the arrangement that was between the principal and manufacturer was a provision of IP as well as certain services. And manufacturing company was established as a fully fledged manufacturer with its own management, salespeople, customer relationship team, and all of that, which would actually partially sell to the existing clients of that company, what we call global clients, as well as they would be also selling to local clients. This company was established about 7-8 years ago, and since then has been incurring losses at operating profitability level, what we call EBIT level. After a few years, it started generating profits at the EBITDA level, but because of significant investment at the beginning to establish this manufacturing activity, it could only recoup some of those in, let's say, 10-15 years before it becomes profitable at EBIT level. Now then, tax authorities saw losses. Well, they are allergic to losses. And then they thought, oh, well, this is an opportunity. Why don't we start, an inspection? What they did, they basically said, well, we consider you a contract manufacturer, and therefore there were also big volumes involved. You should pay, stable amount of tax every year. They also, forget about most of the comparability factor before they start building their case. Among others, basically, let's start with the agreement. There was no contract manufacturing agreement in place that would limit basically the risk of the manufacturer. Secondly, if you look at functions and risks, then also there the company employed, like I said, salespeople, customer relationship managers. They were doing some sort of manufacturing R&D to improve manufacturing processes. So from a functionality perspective, it also didn't look like a contract manufacturing company. Then if we look at business strategy, the company knew from the beginning that I'm going to invest, let's say, a couple of $100 million of financing into building a huge manufacturing facility. I know I will be making losses in the first 5 to 10 years, maybe even longer. But at a certain point, this will become a profitable business once the investments are recouped. That business completely ignored by the tax authorities at the beginning. Another aspect, this is a company that operates in commodities business, and commodities, some of the commodities businesses, they don't create huge margins. The margins are rather low, let's say anywhere between 2 to 4%. So that also means in terms of reality of the business, even, let's say, manufacturing margins that can be allocated to certain businesses cannot be as high as you would normally find through benchmarking studies. Well, lucky for us in this case, we managed to convince tax authorities that business reality was completely different than they thought it was. But again, initially they did not sufficiently consider consolidated profit view that one would need to take into account, and we really had to have long discussions with them to bring them to level that they understand, oh, this is really a different business, and we need to understand the business before we can jump to any conclusions. That was the second case. Also going back to what Scott said, it's not only about profits, it's also about losses. In both cases, well, the losses also played a role. Now, if we move to the third case, that's about method selection, and not this one. If we can skip this one, go to the Dolce & Gabbana case, and then we can go back to the benchmarking. So in this case, the Dolce & Gabbana, the company Dolce & Gabbana, used the TNMM to basically price its intercompany transaction in relation to sales activities. And the Italian revenue agency challenged that, said, well, this is a very famous company. You cannot just use TNMM because it would give you industry averages. But Dolce & Gabbana, everybody knows it. This is a very reputable brand name. Is very famous also in terms of design. Therefore, even sales activity cannot be compared to average sales activities out there. Well, I must say the taxpayer did not have a very good defense line. They said, well, the data, based on data availability and practicality of using TNMM, we thought TNMM is a better method. In this case, the court sided with the tax authorities, saying that if there are reliable transactions, especially transactions that also include intellectual property elements that would better capture brands like Dolce & Gabbana or valuable, let's say, and brands that are acting in the luxury business, those should be considered. So they sided with tax authorities accepting the CUP method instead of the TNMM. With that, let's move back to the IKEA case. Well, IKEA case is Spain versus IKEA is about two aspects. One, first of all, whether interquartile range that we use can be determined on a multi-year basis instead of year-by-year analysis. As you know, you can compare every year that you benchmark that every year of the test party with a benchmarking analysis, or you look at the 3-5 years to smoothen out basically seasonality effects or cycle effects if there are any of this available. I think in practice, tax authorities can be very pragmatic about this, because in the end, it's about whether a company is reporting profits over a period of time and not only in 1 year. But in this very specific case, the Spanish tax authorities disagreed with IKEA. The other element they were challenging is whether the whole interquartile range can be used or whether the median should be used. Also, in this case, not also, because in this case, the court largely sided with IKEA. It confirmed that multi-year analysis are valid for assessing especially trends and seasonality effects, especially if comparables that are using are consistently selected, so that you're not basically cherry picking to get to an outcome that is working in your benefit. In relation to whether interquartile range can be used or not, this is somewhat in line with Dutch guidance in the transpricing decree as well. Basically, they said if there are no basically major the comparability defects in your analysis, you don't have to use median. You can also rely on interquartile range. Also there, they sided with IKEA, saying that any point within the range can be considered arm's length. Our starting point when we perform these exercises, we say, well, you should use interquartile range and also median, unless you have a good reason to deviate from. That's more to be prepared in case you're challenged. But in this case, court could also side with you, even if you have, well, you may need to provide some justification during your proceedings. But even if you don't have a strong substantiation, but you say my comparability analysis was good enough to use the full interquartile range. Now, with that, going to the next case about losses, and this is a kind of a topic that comes back in many discussions, especially when you're dealing with entrepreneurial companies. I think in those cases, it's more kind of self-explanatory that if there are losses should be shared. But as you have seen in the transfer pricing audits, the tax authorities don't always agree with you. And on the contrary, they may be allocating all profits to one side that would result the other one in a loss position. And that's not any of their concern sometimes. In this case, the benchmarking study, or let's say the case dealt with whether loss-making comparables should be excluded from set of comparables if you're benchmarking routine activities. And also this case is in Italy. Apparently, Italian tax authorities are very enthusiastic about challenging benchmarking studies. So Italian tax authorities said, like any authorities actually would say about these activities, you need to exclude loss-making companies from the benchmark if you are benchmarking routine functions, because if they are earning stable profit, they should also not be making losses. Otherwise, the upside for them should also be high, which actually makes sense if you think about it. It's kind of common sense. But the court ruled in this case in favor of taxpayer, saying that let's say the mere presence of loss-making comparables in a comparability set is not a reason to reject the benchmarking study, and loss-making comparables should not be automatically excluded from that. In fact, they said it should only be excluded, and it's also in the OECD guidelines, if there is a special financial situation, or for instance, if the company is going through insolvency or is being liquidated, which is kind of I must say, quite interesting compared to what we do in practice. We often exclude these companies, even when we do these benchmarkings ourselves. But as this case shows, it could also be argued apparently otherwise. Now, the last case.
Rezan, before
Federico, do you have any questions here?
I just wanted to confirm that as far as I see in Italy, the most frequent way through which tax authorities challenge transfer pricing studies is indeed adjusting the benchmark, taking in or out companies. But as you write in this slide, I see that the treatment of loss-making comparables is quite non-homogeneous across country, because, for instance, the Chinese tax guidance, as you write, emphasizes the routine entities that should remain with the level of profits. But do you think that this issue is due to the fact that the OECD guidelines should be improved when dealing with the comparability section, or do you think that some countries are just misapplying what the OECD guidelines mandate to do?
I think, first of all, guidance is very likely not sufficient because it doesn't say a lot. It just provides a principle saying, well, unless there is a special situation, you should not automatically reject them, which is quite like OECD guidance. They provide principles, not really the concrete manual in terms of how to do that. But I think let's say if you think about tax authorities, they're being somewhat opportunistic, but at the same time, it's very difficult to basically come up with a situation where, when you are a routine company, when you can actually make losses or not. In practice, it happens a lot. I was dealing with a company during COVID that was active in hospitality industry, and they needed to basically fire all of their people in the Netherlands, but they didn't do that due to basically subsidies that were provided by the government. And they applied for those subsidies. the government body that was assessing those subsidies said, well, you're not entitled to it because you have an agreement with your principal that should remunerate you with a routine remuneration. So it can have far-reaching consequences, even if the reality of the industry and the business is suggesting a completely different outcome, like COVID-19 crisis or financial crisis of 2008 and 9 had also severe impacts. So I think it's again going back to what is the reality of the business and how would this turn out under kind of real circumstances. And it's very difficult to find the response to that. And therefore, tax authorities or OECD is leaning more towards kind of midway approaches instead of coming up with specific guidance.
Okay, thank you. We can now move to the next case.
Yeah, this is kind of the last case, and then maybe we can have some concluding remarks. This case was about provision of intercompany loan that again, if I'm not mistaken, again, Italian company attracted that or received a loan from a German parent, and they applied an internal CUP. They determined the rate based on an internal CUP. The tax authorities claimed that the interest rate was too low and not in line with the market rates, even though there was an internal CUP. And they they basically performed an external benchmarking study, which we usually do using Loan Connector or Bloomberg, and they came up with a higher rate. Of course, taxpayer disagreed with that, and then they argued that the loan conditions, risk profile, and context of intragroup transactions are often very different from what you see in the benchmarking studies, which I personally completely agree with, because it's a bit of a kind of random, not so random, but still somewhat random selection based on databases that you don't really know let's say actual realities, facts, and circumstances of the parties that are entering into transaction. In this case, court also agreed with the taxpayer. It emphasized that the method selection must follow reliability and relevance of the data. And they also said internal CUPs, if they are available, can basically offer more accurate picture of the arm's length principle, arm's length pricing than external CUPs, which is also in line kind of with OECD guidelines that gives preference to internal CUPs if there is reliable data. With that, maybe some concluding remarks, and I know we have a couple of minutes. I'll try to use 1 minute and then give the 1 minute back to Scott. I think starting with transfer pricing is just a tool. Let's not forget that it's just a tool to allocate groups, consolidate profits among its members, and it could also be losses, and you need to do that in a fair and consistent way. Then comparability analysis is there. And actually, in my view, it needs to tell the story of the business. It needs to tell the story of the business. Under what circumstances is business operating? What kind of profitability are being achieved in the industry that you're dealing with? And you should not basically have a mechanical approach to comparability or to benchmarking studies. You should really understand your case, let the comparability factors tell the story of the business for you, and then if you do that results in something that resonates with tax authorities, and even if the tax authorities disagree with you, you may use that story to convince the court eventually. With that, I would like to thank you and give the word back to Scott.
Yeah, thank you, Rezan. You made very clear to all of us that the importance of a proper understanding of the concept of comparability, and especially of all the 5 comparability factors, because these impact not only the price itself, but also the selection of the TP method, the functional characterization of the entity at stake, so all the most important part of a transfer pricing exercise. So at this point, I would ask Scott if he has something to add before moving to the conclusion of the webinar. If not, I can go ahead. Scott?
I'll say two concluding things very briefly, if I may. The first, and this,
Sure.
I hope this came through from my comments, and I think it underlies what Rezan was saying too, is notwithstanding what the mechanical technique may be arising from the transfer pricing methodologies. I think inevitably, and in my view, with justification, if one thinks about Article 9, the approach that is in mind, whether or not it's spoken this way or not, in a transfer pricing analysis is a profit split. I mean, we can debate profit splits and what kind of profit splits and whether it should be transactional or contributory or whatever it happens to be. But I think that the mindset underlying most transfer pricing analyses is a profit split, and it's a very healthy thing to do, to have that outlook and to anticipate that not illegitimately is in the mind of tax authorities when they examine in M&E circumstances. The second thing I'd like to say, and it's particularly a hobby horse of mine, is that too often I think the transfer pricing guidelines, as they have been mythologized, are seen very easily to allow tax authorities in particular to dismiss the legal formulation of transactions. And I'm not talking about the legal formulation as a picture on a whiteboard. I'm talking about the method among alternatives that taxpayers may have taken in order to organize their affairs. The question, I think, and I responded to this question in the chat, is not whether or not a transaction should be recharacterized in quotes or not recognized in quotes. The question always is, what is the transaction? And that's a legal determination based upon evidence. That is, yes, the parties purport to do this, but on an evidence-based analysis of their capacity to act, their financial capacity, their functional capacity, is this a conceivable transaction for them as they have formulated it? And if the answer to that on the evidence, which is a legal analysis, is no, then the next question is, well, what is their transaction? And once the transaction is not some exercise in actuality. It's not an economic question, it's a legal question. And so it's derived from evidence what the legal rights and relationships are. And then one can then proceed to examine the question about whether or not the financial fruits of that transactional arrangement are compatible with the expectations of Article 9. That's what all I have to say.
Thank you, Scott, for your final remark. We are now approaching the end of our webinar, but before closing, I just want to remind our audience that there will be 2 more webinars in the series. So make sure to follow us on LinkedIn and subscribe to our newsletter to be updated on our activities. With this, I thank our audience for the attention, and I look forward to seeing you on the 9th of April for the second webinar of the series. Goodbye.
Goodbye. Thank you all.
Thank you. Bye.